The thing about investing and investing your way to become a millionaire is that it's actually pretty easy, and no one really tells you that. I'm David Paul, and I've built multiple seven-figure businesses and a substantial investment portfolio, but I started with next to nothing, so you can definitely do it too. Investing isn't hard or complicated, and there is a simple path to follow to become a millionaire investor, regardless of where you're starting from. This isn't about getting rich quick, this is about getting rich properly. And if you stick with me for the next few minutes, I promise you'll understand exactly how to start building serious wealth through investing, even if you've never bought a single share or fund before. The biggest lie in investment is that you need to be some kind of Wall Street genius to make money in the stock market. It's complete rubbish. You don't need to be a genius at all. I'm yours truly, for example. As I explained in my investment newsletter, you can find the link to the bio if you'd like to join that. All investing means is that you're putting your money to work so it makes more money for you. Simple as that. More importantly, let me tell you what investing is not. Investing is not gambling. It's not a get-rich-quick scheme, and it's definitely not about following hot tips from your mate down the pub. Think about this. Every single day, your money is losing value if it's sitting in a basic savings account. With inflation running at 3 to 4% annually or even more, that $100 or £100 for my UK friends in your account will effectively be worth only 96 next year. After about 10 years, it's worth only 70 in today's buying power. That's why investing isn't just about making money. It's about not losing money to inflation. It's about having your wealth grow faster than prices rise. But here's the thing most beginners never grasp. Successful investing is boring, dead boring. The most successful investors I know, including myself, didn't make their millions through exciting adrenaline-pumping trades or crypto. We did it through consistent, regular investing over time, saving what we could, when we could, and investing that into the stock market. Warren Buffett, arguably the greatest investor ever, he still lives in the same house he bought in 1958 for $31,500. His approach is to buy quality and hold for decades. Now, that's not exactly Instagram or TikTok-worthy content, but it works, and that's what matters. The most important piece of investing advice I'll give you today is to start now. The maths behind this is absolutely mind-blowing. Starting early is so powerful, even with small amounts, and here's why. Imagine you had two friends. Let's call them early Emma and late Larry. Emma starts investing just $200 a month at age 25. She keeps this up until she's 65. That's over $96,000 invested over 40 years. Larry, however, waits until he's 35 to start. Feeling behind, he invests $400 a month. That's twice as much as Emma did until age 65. Now, that's $144,000 invested over 30 years. Now, if you assume an 8% average annual return, Emma ends up with about $622,000, whereas Larry ends up with $589,000. So despite investing 50% more money in total, Larry ends up with less than Emma. This is the magic of compound interest and time in market. And if Larry had waited until 45 to start, he'd have needed to invest $1,200 every single month to catch up with Emma. This is why if you take nothing else from this video, take this, start investing now. Whatever you can afford, whatever it is, even if it's just $50 a month, your future self will thank you, as will your future family. When I started out, I forced myself to invest $100 every month, even when money was pretty tight. Those early investments, despite being small, have grown to be among the most valuable in my portfolio because they've had the longest time to compound. I then added to it whenever I could with whatever I could afford. If I got a bonus, sure, I treated myself to a little holiday, but I invested the rest. Remember, the best investment strategy in the world is worthless if you don't take action. You know the best time to invest, right? Yeah, that's right. It was years ago. The second best time to invest is now. But it's not just all about investing. To be a successful investor, you also need to have income to invest. Ultimately, increasing my income was the single biggest thing I could do to increase my wealth over time. Not just because of the income itself, but because it gave me more money to invest each month and every year. Now, I'm not saying you need a huge income to be an investor or to become a millionaire. You don't. You just need to invest regularly, and you need the amount of time it takes to grow that money. But the more income you can earn, the less time you're going to need to reach your goal, and the more wealth you'll create over the long term. So it's not a case of investing your way to wealth. It's about earning money, with that money then being used to invest and create wealth in that order. So don't forget about the income side of things. Maximize your income wherever you can. If you've got 1,000 to invest right now, there are only 3 smart places to put it. Let me show you. There are 3 primary ways to invest in the stock market, and I've used all 3 to build my portfolio. So let's break them down. Number 1 is individual stocks. This is where you buy a share in a specific company, something like Apple or Tesla or BP. In the UK, for example. The upside is that with this approach of investing in shares is that when you pick winners, the returns can be incredible. For example, I bought Amazon in 2013, and well, you know where it is now. But the downside to picking stocks is picking individual winners consistently. It's extremely hard. Even professional fund managers get it wrong a lot of the time. And when you only own a few stocks, your risk is really concentrated. If one company tanks, your whole portfolio takes a massive hit. So personally, although I do hold a few individual stocks, it's not really my focus. Next up is mutual funds, or in the UK, we sometimes call them unit trusts. These are professionally managed pools of money you and thousands of other people just like you put money into, and then a fund manager decides which stocks or which not to buy. The upside with mutual funds is professional management and instant diversification across dozens or hundreds of companies. The downside is that, well, the fees can be quite high and they can eat into your returns over time. But if the returns are above average, then that doesn't always matter. As I've explained before in my investment newsletter, which you can sign up to in the link in the bio, unfortunately, not all fund managers do beat the market. Although I used to almost exclusively invest in mutual funds, I increasingly use index funds or ETFs, which I'll talk about in a minute. And I only tend to use mutual funds now when I want to follow a specific theme. So for example, if I felt Africa was an investment theme over the next 10 years, I might look for a mutual fund that focused on Africa. Likewise, I have some agriculture mutual funds. They are a great way to follow a particular theme or sector, providing they have a decent manager and a good track record. And I mean a track record over a long period of time. But the easiest way to start out is by buying index funds or ETFs, otherwise known as exchange traded funds. This is certainly how I invest most of my money these days. Index funds simply track a market index, so something like the FTSE 100 in the UK or maybe the S&P 500 in the US. ETFs work similarly but trade like stocks and can be easy to buy. They often have ultra low fees, sometimes 0.1% or less. They have instant diversification and historically solid returns. The S&P 500 has averaged about 10% annual returns since inception. The downside is that you'll never dramatically outperform the market, but consistently you'll match the market returns, and that's actually an incredible achievement that beats most professional fund managers over time. So should you buy individual stocks, mutual funds, or index funds? That's the question. For most beginners, index funds or ETFs are where to start. They're the simplest, lowest risk, and historically most reliable way to build wealth. As you gain knowledge and experience, then you can add mutual funds or follow a particular theme or individual stocks even. My own portfolio is about 65% index funds, 20% mutual funds, and 10% individual stocks that I believe in over the long term. And then I've got 5% in more speculative investments. And yes, it does include a few of the better known cryptos. And I mean the better known cryptos, not the dodgy meme coins. This gives me the stability of the overall market while allowing for some potential outperformance. To start investing is easy. First, you choose your platform, that is a platform or brokerage account that you can invest through. In the UK, you've got firms like Hargreaves Lansdown or Interactive Investor that have easy to use platforms. Now in the US, similar options would be Charles Schwab or Fidelity. But don't fret too much over which platform or which company you use. I've seen So many people spend so much time researching, they get so overwhelmed, and then they give up. So pick one provider, one platform, and then get on with it. Next, you're going to need to fund your account. Start with whatever you can comfortably afford, whether that's 50 a month or 10,000 a lump sum, whatever it is to you, whatever it means to you, do whatever you can afford. Remember, the best investing approach is one that you can stick with long term. Don't put in so much that you're going to panic and withdraw when the markets inevitably dip. Once the account is open and funded, usually that only takes a few minutes, you can then pick your first investments. After doing your own research, you'll probably conclude that you're going to need some kind of index fund. So that might be some kind of global all-cap index fund that tracks thousands of companies worldwide. You could also consider major market index funds that follow established economies like the US, S&P 500 or UK. There are balance funds that include some bonds if you're more conservative. And your platform provider will probably have quite a lot of research on their website, maybe even some suggestions. Read all the research, collate from different places, and then make your decision. Don't just trust someone like me on YouTube, right? Do your own research. Spend a bit of time looking at and researching. You're going to learn more by doing that and become a better investor. Consider what aligns with your personal financial situation and goals. Also, don't forget to set up regular investments too. This is crucial. Set up an automatic monthly investment, even if it's only just 50 or 100 a month. This approach of regular savings is good for two reasons. Number one, it removes emotion from investing. You won't try to time the market. And number two, it leverages dollar cost averaging. That is buying more shares when the prices are low and fewer when the prices is high, and averaging this out over time. The most successful investors I know, including myself, built wealth through consistency, not timing. Then, and perhaps the most important step, and probably the hardest to do, is forget about it, mostly. The best thing you can do after setting up your investments is absolutely nothing. Check your portfolio quarterly. The more you look, the more you're likely to make emotional decisions that harm your returns over the long term. When I started investing, I checked my portfolio daily. It was stressful and led to really poor decisions, me buying and selling and buying and selling. Now I review it thoroughly just twice a year, making minor adjustments if needed. Sometimes I might pop in if there's a major event, but not if there's a crash. The only time I'd log in really if there was some kind of crash is to buy more. But I'm not checking it all the time. I know people that check their portfolio, hundreds of times a week, several times a day. And it's just ridiculous, particularly if you're investing in tracker funds or sort of lower risk investments. I get it, if you're a day trader, you're going to be in there all the time, but that's not what we're suggesting here. Definitely not what we're suggesting here. But if you're a long-term investor, you really only need to be checking your portfolio quarterly at most, because anything more than that, and you're going to end up what I would call churning your portfolio. Do you know what separates millionaires investors from everyone else? It's not their stock picks, it's their investment strategy. And there are only a few that really work over the long term, time and time again, to build wealth, long-term wealth. First, we talked about it already, dollar cost averaging. I touched on it earlier. This simply means investing a fixed amount at regular intervals, regardless of market conditions. This gives you a chance to grow as the market grows. So, for example, invest 500 on the first of every month or 100 on the first of every month, no matter what. When markets are down, your 500 gets you more shares, right? And when the markets are up, it buys a few less. This approach removes emotion from investing and historically provides excellent returns. I've automated monthly investment into index funds for over a decade. It's not sexy, it's not interesting, but it's built a significant portion of my wealth with zero stress. Next, value investing. This approach involves finding companies that are trading below intrinsic value, essentially stocks on sale, if you like. Now, I'm not going to go into too much detail on this as it needs time and patience. And as we talked about before, picking individual stocks isn't the best approach for a beginner. But look for companies with low price to earnings ratios relative to their industry. Again, you can research that for yourself online. Strong balance sheets with little debt. And you want consistent cash flow with dividends. You'll also want competitive advantages in whatever industry they're in. I use value investing principles for the portion of my portfolio dedicated to individual stocks. It does require a lot more research and time, but it can produce exceptional returns, but probably isn't for the beginner. Next is long-term growth investing. This strategy focuses on companies with above average growth potential that you're going to hold for years or even decades. These aren't necessarily cheap stocks. In fact, they often look quite expensive by traditional metrics, but they have the following criteria. They're going to have expanding market opportunities. They're going to have strong revenue growth. They're going to have competitive advantages that strengthen over time, and they're going to have excellent management teams. Amazon, Microsoft, and Google looked expensive, right, for most of the past 20 years, yet they've delivered extraordinary returns to patient investors like myself. You can follow a similar approach with mutual funds, where you choose a particular theme. Like I said earlier, Africa, China, technology, agriculture, whatever it is, and you look for a fund with strong track record over a really long period of time and a really good fund manager. The strategy I use to become a millionaire is simple, and I'm happy to share it with you now. And I do, it's really simple, all of the above. Most of my portfolio, about 65%, is in global index funds or ETFs that I dollar cost average into monthly. I have about 10 to 15% in mutual funds, which I follow with specific themes that I like and that I'm positive about, and that I think have long-term growth prospects. I have about 10 to 15% in individual value stocks or growth stocks that I've researched thoroughly. And then I've got 5%, which is like riskier assets like crypto. And even then, none of them are meme coins, just the better known crypto. But that's if you like my play money. This gives me the reliability of the overall market's growth over the long term and allowing for a bit of potential outperformance through carefully selected individual companies that I've researched at length. The key with any strategy is consistency and patience. Wealth through investing is built over years and decades, not days and weeks. If you want to know the biggest mistake that most investors make and keeps them poor, it's not picking the wrong stocks, it's something much more basic. After mentoring dozens of new investors, I've seen the same mistakes repeatedly destroy potential wealth. So avoid these pitfalls at all costs. Investing mistake number one is trying to time the market. People say, I'll wait until the market drops before investing. Now, if I had £1 for every time I've heard this before, I'd be twice as wealthy. The truth, well, nobody, not me, not Warren Buffett, not the slickest Wall Street analysts, can ever consistently predict the market movements. Studies show that missing just the 10 best days in the market over a 20-year period can cut your returns in half. And guess what? Those best days often come right after the worst days, when most people are too scared to invest. Time in the market beats timing the market every single time. Investing mistake number two, chasing past performance and fads. This fund returned 40% last year, so I'm going all in. Past performance does not guarantee future results. In fact, last year's winners are frequently next year's losers. I've seen this cycle repeat countless times. People piled into tech stocks in 1999 and then watched them crash in 2000. And whilst a few have thrived, most have gone. Remember when everybody crowded into meme coins right before they crashed? And don't get me started on the NFT bubble that burst, leaving lots of people with huge losses. Unlike the so-called 20-year-old stock market millionaires on YouTube, I've been around long enough to know that every few years there's a new investment fad promising quick riches, NFTs, AI companies, metaverse plays. The names change, but the patterns don't. The pattern is always the same. Early adopters make genuine returns. The media then reports these success stories. It's flashed all over the news, over TikTok, over Instagram. The masses then rush in, driving prices to unsustainable levels. Smart money at this point exits quietly, that's people like me. A crash occurs, leaving latecomers with heavy losses. It's always the same. I remember in the tech boom in the late 90s and 2000, I had some young guy come and fix something in my house, right? And I just couldn't believe it. He was telling me about this great stock he was tipping that he'd heard about down the pub, and he put all of his savings in. At that point, I knew the tech bubble would burst, and true enough, it did. It did within a month or so, and no doubt he unfortunately lost all his money. I'd been an earlier adopter in the tech boom. He wasn't. The antidote to fad chasing is having consistent long-term investment strategy and sticking to it regardless of what's making the headlines. Slow and steady really does win the race. When everyone is excited about an investment, it's often way too late. When everyone is terrified, well, maybe that's the time to buy. Do your own research. Instead of chasing the latest hot investment, focus on consistent long-term investment strategies rather than what's hot right now. I'm not saying you can't play a little with a few riskier assets if you have done your research and you've considered the risk and you can afford to lose whatever money you've put in. Feel free to play with a tiny proportion of your portfolio, but be aware that you are playing, you are gambling, you're not investing, you're taking a bet that something might come off. Some will come off, but most won't. The next mistake people make when investing is letting emotions drive their investing decisions. The market drops 20%, and what do most beginners do? They panic and they sell right at the bottom. The market jumps 20%, and what happens? They get greedy again and go in all at the top. Investing success is 10% knowledge and about 90% patience and emotional control. Create a solid plan when you're calm. Then stick to it regardless of market conditions or whatever the news is talking about. During the 2020 COVID crash, when markets fell over 30%, I didn't sell a single share. Instead, I increased my monthly investments. 2 years later, those investments have nearly doubled. Investing mistake number 4, ignoring fees, but also ignoring past performance when it comes to investment costs. There are 2 mistakes beginners make frequently. First, they completely ignore fees. A 1% difference in fees might seem trivial right now, but over 30 years on a 100,000 investment, that's the difference between having 1.8 million and 1.3 million. That's a lot. Always check the ongoing charges figure, the OCF or total expense ratio, TER, before investing. For basic index funds, anything above 0.3% is worth comparing to cheaper alternatives. But the second mistake can be just as costly, focusing only on fees at the expense of performance. So if Fund A charges 0.1 and returns 7% annually, whilst Fund B charges 0.8% but consistently returns 9% after fees, Fund B is actually clearly the better choice, despite the higher costs. Some actively managed funds do outperform the benchmarks, even when accounting for higher fees. So after doing your own research, you might actually find that some mutual funds are worth considering, even though they might have higher fees. Particularly maybe if you want to get access to a particular sector of the economy or a particular theme of investing, where mutual funds might have a wider range of options. The key is to look at net returns after all fees over really long periods of time, so ideally 10 plus years. Don't just dismiss a fund because the fees are high. Have a look at the performance. What matters is what ends up in your pocket after all the costs. The next investing mistake, number 5, is not starting soon enough. This is the deadliest mistake of all. Due to compound interest, the earliest years of investing are by far the most powerful. If you invest 10,000 at 25 and never add another penny, at 65 you're going to have about 175 grand, assuming 7% annual returns. If you wait until 35 to invest, that same 10k is only going to be worth 87k at 65. If you wait until 45, it's even worse. You're only going to have 43k. The maths is brutal when you delay. So when should you start investing your money and how much? Let me give you a really straight answer to this because nobody ever does this. As I keep saying, the perfect time to start investing was yesterday or 20 years ago. The second best time to start investing is today. But there are a few things to do first. Before you invest, build up an emergency fund. Make sure you have about 3 to 6 months of essential expenses saved in an easy access account. This prevents you from having to sell your investments or panic when they're losing money or if unexpected costs arise. Next, before you invest anything at all, clear any high interest debt. If you're paying 80% interest on credit cards, no investment will reliably earn you more than that. Clear those debts first. Next, always determine your time horizon. Money you'll need within 5 years shouldn't be in stocks, period. Here's a rough guide, right? If you need the money in 0 to 2 years, we're thinking cash or savings accounts. If it's 2 to 5 years, then mostly bonds or very low risk funds. 5+ years, then stocks, index trackers, mutual funds. And obviously as you age and approach retirement, you might begin reversing that trend and getting less risky as you get older. But that will depend on your goals and your timeline. As for how much to invest, I recommend the 50-30-20 rule for beginners. That's 50% of your income to your needs, that's housing, food and transport, 30% to entertainment, dining out. Now you could cut that massively down, I suspect. 20% to investing and saving, and then as your income grows, you try and increase the investment percentage. I currently invest about 40% of my income, but the bottom line is to try and save and invest as much as you can, and consider going without some things to make that happen. Now, I have another video about money mindset, which shares some tips around maximizing savings and investing. But if you're starting out small, that's okay. If you're investing 100 a month at say 7% annual returns, that becomes 17,000 after 10 years, 59 after 20 years, 150 after 30 years, 350 after 40 years. You get the idea, right? The key is consistency. I started with just 50 a month as a newbie doing a monthly savings plan. Today, that initial phase of small investments has grown to over 6 figures through the magic of compound growth, and my overall portfolio is worth millions. Let's talk about keeping more of your investment returns through tax-efficient accounts. For UK investors, we're talking about ISAs, that's individual savings accounts. This should be your first stop. You can invest a set amount each tax year, and all gains and income are completely tax-free forever, at least at the time of recording anyway. I max out my ISA allowance every year before investing elsewhere. It's the closest thing to a financial no-brainer that exists. Next in the UK is a SIP, a self-invested personal pension. The government adds 20 to 45% to your contributions through tax relief, depending on your actual tax rate. That's free money, essentially. The catch, well, you can't access the funds until you're 55, but that's rising to 57 really soon. Now, I use my SIP, my self-invested personal pension, for long-term investments I won't need to touch for decades. And I look at it about twice a year and change it up. For US investors, it's things like 401k or employer retirement plans. If your employer offers matching contributions, contribute at least enough to get the match, right? It's literally free money. You've got Roth IRAs, traditional IRAs. These offer tax advantages too, similar to UK ISAs and SIPs. Prioritize these after getting your employer match. Maximizing my tax-free investments has literally saved me tens of thousands in taxes over my investing lifetime. Money that's still working for me in the market instead of going to the government. And whilst I'm in favor of taxes, right, it's always a good thing for it to be in my pocket rather than theirs. Let me leave you with the most important investment advice I can give you after building a 7-figure portfolio. The biggest obstacle between you and your wealth isn't knowledge, it's action. I've met countless people who've spent years researching and learning about investing, going on courses, but they've never bought a single share. Meanwhile, some idiot like me who actually just started investing earlier, didn't know anything at all, has built significant wealth. Remember, time in the market. Take action. Perfection is the enemy of good enough. You don't need to understand every aspect of the market to start building your wealth. If you take just one thing from this video, let it be this: start now. Start with whatever you have, whatever you can afford. Start consistently. Remember what we discussed about the power of starting early. Someone who invests a small amount now, even in their 20s, often ends up with more than someone who invests double or triple that amount in their 40s. But it's never too late. This isn't opinion though, it is mathematical fact. Don't fall into the trap of waiting for the perfect time or until you have enough money to start. There isn't ever a perfect time, so start now. Open an investment account this week. Set up a monthly investment, even if it's 50 or 100 a month. Choose a well-diversified fund, an index fund, after doing your research. Then let time and compound interest work their magic, because they almost always do. And make investing a priority as your income grows. Remember our discussion about building multiple income streams, because as those grow, you can increase your investment contributions over time. The combination of consistent investing and increasing contributions over time is truly powerful. 5, 10, 20 years from now, you're going to look back at this moment, the moment you started investing, as one of the smartest financial decisions that you've ever made. If you found this video helpful, please make sure you subscribe to the channel. And if you want to join my free investment newsletter, click the link in the description below. It's completely free to join, just go take a look. My name's David Paul, and I hope I've helped you today. And if I have, then please do give me a like. Until the next time, bye for now.